Okay, so welcome everyone. My name is Michael Guyman. I'm Vice President for the Tucson Metro Chamber, and I want to thank you all again for coming to part two, the exciting part two of the Arkona presentation. The part one was fantastic. I learned a lot, and I'm sure our members who joined us learned quite a bit. We're very excited that Ryan and Pat have joined us again for part two of these presentations. This is really a way to that they're going to help you as a business discover how your financials can tell the story of past trends and are really the backbone of your future strategy. This is a way, if you follow this method and the things that they're going to be talking about, can really strengthen your business and help you grow in a way that you probably never really understood. So just want to thank Ryan and Pat again for being here. Thank you for your partnership. Thank you for presenting all of these great materials to us. And I will turn it over to you.
Thank you very much, Michael. And good to see everybody. Raise a hand. Is it Yvette and Melissa? I don't know if, well, I can't see Melissa's hands, but I don't know if you guys attended the first one. If you did, we can jump through some of the intros. Otherwise, I can just give a quick background of Pat and I's experience, and then we can jump into it. And hopefully, if you got questions, feel free to interrupt us, and we can make it a little bit more engaging and interactive if you've got some things that are top of mind. All right, so I'm gonna share. All right, you see my ugly mug? There we go. Can you see the PowerPoint, everybody?
Yeah.
Okay. So a little bit of background on me, and then I'll tee it over to Pat, and we'll talk a little bit about how we created Arkona, and we're going to be diving into the financials, and we've got a case study to show everybody today. So I joined my dad in our family business around the financial crisis. He had grown it from the ground up, so 0 employees up to 21 million in revenue and 115 employees, selling copiers and managed IT services, and joined full time. It was a lifestyle business for him, and so I kind of pulled him back into the business and realized that we were in a major kind of a pivotal decision, some pivotal decisions that we had to make as we turned around the business. The margins dropped out of the equipment, and had we had what we're about to discuss today, I think our decisions would have been a little bit more informed. Anyways, we turned the business around over the next 5.5 years after I started, and it was from new systems, new processes, built out the managed IT services, and rebranded ourselves. And this whole point of what my dad and I were trying to accomplish were different. He wanted more money out of the business each year. He wanted more freedom on his day-to-day role. I wanted to reinvest in the business. I wanted to grow for the long term, and just reconciling those differences and understanding what our options are was difficult. And so we did what a lot of people do, where if the internal buyout transfer doesn't work, we looked at the competitive landscape in the industry and in our marketplace, and we pinned a couple of local competitors against each other and sold the business. And that day we sold, we went back, had to fire 60% of the employees, paid a lot in taxes, a lot in debt, paid off our debt. And, I was then, I went from running the business to sit next to an intern in the cubes of the buyer that bought us. And I went, well, this is not what I had envisioned. And so started consulting with some people and some business owners from my CEO peer groups, and just realized that the big challenge in the marketplace was education and understanding my options, understanding how to take my vision of the business and what I wanted from life, integrating that into the business and growing towards that goal. And it came down to an education issue. So started with the 5 principles. I went to a training. I met Pat. Pat was stuck next to me for 5 days, 10 hours a day. So whether he wanted to listen to me or not, he heard my story.
And seemed like 5 weeks.
Yeah, no choice. And then a couple beers after some of the training, and there was some solid synergies. So he'll tell you his background, and he helped me complete a lot of the ideas that I had, which led to the 5 principles and some of the stuff you're about to see today.
Hi, everybody. Great to be here with you today. My name is Pat Hobby. I'm an accountant by education and trade, and I spent the bulk of my career being a fractional CFO, working with business owners alongside them as a financial strategic partner to help guide them through the process of growing their business. And that, like Ryan, I wish I'd had a lot of the framework and terminology and that we've developed. It would have made life a little bit easier, but had some great experiences with a lot of different clients. I had one client that was a pretty big client. We made a couple of acquisitions that went really well. The business was just booming. And the owner at the ripe old age of 47 said he wanted to get out. So we sold it to an ESOP. We sold the company to an ESOP. We explored a couple options, and it was a family business, and legacy was really important. So the owner decided to sell it to an ESOP, which we did in 2014. It was just a great experience. The employees loved it. If you were on the call last time, we went over that. So just a terrific experience. But then a couple of years later, a private equity firm approached us and wanted to buy us, and we were very resistant, and eventually gave them a number that we thought would make them walk away, but instead they paid it. And so the employees who were the beneficial owners of the company through the ESOP just made out handsomely. We distributed about 23 million $23 million to about 180 people, which turned out to be about double their annual salary. So that was just a great outcome for them. I went to work for a local, and by local I mean Dayton, Ohio, private equity firm, and they were in the early stages of being a PE firm. So they were buying companies, and I was on the back office side. I wasn't on the deal side. So, when we got to these companies, it was kind of like, okay, what do we do with them now? Because the whole goal of PE firms, as we talked about last time, was to get a rate of return for the investors. So they've got to drive value for the inside the company, value that the previous owner kind of left on the table. So we were looking around for a tool to help us figure out what to work on first, because you can't do a whole bunch of things well at one time. Came across this tool that a guy developed in Boston about how to evaluate the 8 functional areas of a business. Went to training in Boston a couple of years ago now. And met Ryan. It wasn't as bad as he thought. We had a great time. We had a great time in Boston, talking about things. And I came to understand, talking with him, about what he was doing with his passion for helping business owners and drive value and create value with an end in mind. And I thought, man, that's really appealing. I'm later in my career, so I have choices, which is what we want for all business owners. So we teamed up, we kind of refreshed what he had been working on for 5 or 6 years and created a 2.0 version. And that's where we are today with Arkona.
And what we're going to be talking about today is some of the brass tacks of the concepts we mentioned last time. So if you're listening to this on the recording, or if you didn't participate the first time, we'll go back and we'll cover a little bit of the ground to give some more context behind it. But what we want to talk about is how to manage the short term while focusing on the big picture. There are decisions because of COVID and all the different things that are happening, and even outside of the pandemic, there's all these decisions when you're running a business that are flying at you, and you need to be able to synthesize those, and hopefully the time, money, and energy that you're spending are bringing you closer to your goals and creating more choices and more freedom. And a lot of times that's not always the case. And we're going to talk about how to understand that. And to kind of relate it to a picture is my analogy is every business owner is building a picture. A lot of people are doing it without building a puzzle. A lot of people are doing it without the picture, puzzle pieces upside down. Super frustrating, super inefficient, might take longer. You'll eventually get there, just not as fun as it could be. So goal is, if you understand what you're trying to go, where you're trying to go and why you're trying to go there, point B. If you understand in point B is in the map, if you were to Google map something, you have to understand where you're going, then all the things can correlate towards that goal. And that's not always the case with the decisions that we're making. So we're going to talk about how that happens. And the goal is, if there's a couple big takeaways, one of them is going to be to shift your mindset away from solving for annual income to focusing on growing the value of your business with the end in mind. And the way to do that is to use these 5 principles that help facilitate that shift in the mindset. And the first one starts with, what do you want from your business and why? This is not a dollar amount specifically. This is, whether it's your legacy or whether it's the community or solving a specific problem in a specific industry, that's your vision. Really taking the time to reflect and identify that first before you start building the entire plan is going to be crucial for your happiness and for value creation and focus.
The second principle of the 5 is your financial targets. And there are 3 of them that you need to be measuring and monitoring continually all along the journey. The first is, what is the annual income you need to solve for? Whether you own the business, you're thinking about selling it, maybe post sale. But like I say, even as while you own it, this is not about exit planning. This is about growing the value of the business. So knowing what your annual cash flow and your income needs to be is the first one. The second one is, what have you saved outside of the business value that can create some passive income for you, which is supporting some of the first measure that we talked about, which is the need for what you need for your annual income. The third measure that you need to have is, what's the value of your business? A lot of business owners wait till they're at a transaction before they even try and figure out what the value of their business is. So there are ways to do that pretty economically and on an ongoing basis that can really give you a baseline and help you drive towards what you're looking for in the long term.
We're going to be spending a lot of time diving into that.
The third principle is exit options. Our educational course is not about exit. But we have that in there because as you go through principles 1 and 2 and you understand what your drivers are and what your financial targets are, every business will transition at some point. The business owner will get to the point where they'll eventually sell it. Nobody gets out alive. So, even if it's upon death, it's going to transition at some point. So once you understand your drivers and your financial targets, and you understand what exit options are out there for you in the future, some of them make more sense than others depending on what your drivers are and what your financial needs are. So understanding exit options, even if that's not something that's imminent for you, can really help frame your decision-making progress, your strategies, and some of those decisions to say, legacy is really important, my community is really important, I want my employees to benefit from it. The exit option might be an ESOP in that case that bubbles to the top. If your financial targets are such that you say, I have to squeeze every last dollar out of a sale at some point down the road because of the circumstances, I haven't been able to save much outside the business, then a strategic sale might be the most logical. But understanding those and incorporating those into your thinking based on the first 2 principles really provides some clarity as to how to approach your business and what strategies to utilize.
And those first 3 principles lay the groundwork to be intentional. You have to, I've got this podcast, 225 plus interviews at this point, and I asked people, what does the word intentional mean to you afterward, at the end of it? And like, the common theme is understanding all your options and knowing really clearly what you want and building a plan to go get it on purpose. It's like, okay, well, you need to know how it could end in order to go get it. So that the first 3 really lay the groundwork. Then the goal is to, how do you grow value to go get that? Not just head down, wake up and hope all the things work out perfectly. And that's what a lot of people are doing. And so with the increasing value is, if you want to grow the value of the business, you're going to create more choices to have more options to do what you want with the business. And that the focus of the first 3 principles should help you de-risk your cash flow by creating more sustainable, predictable, and transferable cash flow that creates more options. And then the last principle is the team of advisors. If you can hand your team of advisors, tax, legal, consultants, all the people around you, your plan, what you want, they can optimize that picture and help you with that puzzle picture to solve that for that picture that you want, versus everybody else trying to figure out what you want because you haven't even articulated it yourself. The goal is that these 5 principles help you shift your mindset away from solving for annual income, how much can I pull out of the business this year, to how do I reinvest to grow a more valuable company that creates me more choices so I can increase the chances that I get what I want from the business. And the goal is getting visibility into the future so you can make better decisions. And what we're going to be talking about is some of those informed decisions and how the numbers can facilitate that. We're not going to go into all these, but this is just, decisions are flying at us left and right as, you know, the elections and COVID and shutdowns on and off. You know, whether you're going to get an out of the blue offer, you got, you know, an acquisition that might surface, or you're going to hire the next president or launch a new product. All these things you have to make a decision on, from time and money and capital, and how you're going to spend it. And it should be getting you closer to your goal, which is a more valuable company, towards an ultimate outcome. If it's not, don't do it. Or make sure that you have to, if there's a sacrifice towards the long goal, you know why you're doing it, because it has a very specific need today. So what we're going to be diving into is, what is the typical financial foundation. We're going to be pulling up an example client. So we're going to go over in each chunks of what a financial foundation looks like. Pat will pull up an example client. We're going to be going through each of these sections to give you a little bit more visibility into what a real situation looks like.
I didn't tell Ryan. I mean, he's the one that's going to walk through all the.
Oh, nice. We had someone say finance and fun. So like, yeah, that doesn't make someone laugh. Before we go into the what does good look like, you know, to give you my personal example is, what does a typical financial foundation look like? Running a $20 million business, we still did what we call bank balance accounting. How much cash do we have? Should we spend money and reinvest it, or should we cut costs because we don't have cash? And it's just looking at the bank and looking at your income statement, and hopefully, you know, just making decisions off of that. You know, too many times we have someone closes out their books, and then, you know, it's 3 years later, we're getting May's financials in August or September. That's not timely and useful. You're not using that to guide the decisions. It's just doing things because you know you need to for compliance and tax purposes. So very different than using the financials to facilitate better decisions. So this is the visionary in me of what does the financials look like in a graphic. And so what we're going to be doing is breaking these down into the different chunks. The first 3 statements, the income statement, the balance sheet, and changes in cash flow, is the foundation for good, accurate financials. Then we can look at the past, the trailing 12 months, that are going to give us insights on how the future looks like. And the annual budget is going to be built from the ground up so we can project out into the future. The goal of being able to say, in 2025, my revenue is going to be X, my equity value of my business and the value of my company is going to be worth Y to me. That is real decisions. And how much in distributions can you take along the way? And what's the balance between the distributions and the future value of the company? So getting into the 3 statement financial example.
Yeah, you want me to share now, or
unless you want me to run it?
well, I can just leave it now. I'm teasing. You can interject. So we just wanted to go through. Typically, as Ryan was saying, a lot of business owners, they get their financials at the end of the month. They look and see if it shows they made money or not, and how much cash is in the bank, and they move on because they don't understand what the statements mean and how they interplay with each other, and what they can discern from all that. I think in 2020, a lot of business owners figured out that having a strong balance sheet was pretty important. We know of companies, fortunately, none of our clients, knock on wood, got to the point they didn't have a strong balance sheet. They had a downturn and they weren't able to survive, you know, the onslaught of problems that came on them. So a lot of people now are appreciative of what
cash.
Well, not only cash, but just the strength of your balance sheet. How much debt do you have compared to your EBITDA? Just all the ratios that that really factor into what helps determine a strong company. So we work with clients, and we use the 3-statement model, which is the income statement, which most people are familiar with. And this happens to be one of a client that was a manufacturing firm. I'm going to scroll out here a little bit. That shows the revenue, the COGS, the cost of goods sold, and the gross profit, and then gets into SG&A. We do this on a monthly basis and on a year-to-date basis. And the third one is, I'll find here in a second. So we go through the income statement. You get to net income, which everybody's familiar with. Then we talk about EBITDA. So EBITDA is a mathematical calculation, which is earnings before interest, taxes, depreciation, and amortization. It is a proxy for cash flow. So it adds back depreciation. It adds back interest. It's a proxy for cash flow if the company was debt-free. And the reason we use that is because the valuation world, that is the metric that they use in order to figure out what a company might be worth in the marketplace. So we do that calculation here. We add back interest, depreciation, and taxes to come up with EBITDA. So in a month where there's $25,000 or $26,000 of net income, there's $59,000 of EBITDA.
And just, I was just say, Pat, for the listeners, why does everybody usually stop at net income and the income statement? And when we think about a multiple of EBITDA, and why do people don't even record EBITDA or normalize EBITDA? Yet, if you have a multiple, like a multiple 4 or 5 times that EBITDA is truly trying to get to the valuation, why are people stopping at the income statement instead of tying all 3 together and looking at EBITDA?
I think it's that they just don't understand, because the sophisticated buyers of companies on the market, or banks even, do it. I mean, when they do their analysis, it's just that nobody's come along to share the information, explain to them why it's important. Because as a business owner, not only do you want to know how much money is my making, you want to say, what is my business worth today? And what is it going to be worth at some point in the future? Whether or not you're intending to sell your business, it's a financial asset. If you put money in and bought Apple stock, you buy it because you want it to grow in the future. And if you have a business, it's a financial asset as well. You have the ownership in that business. You want it to grow into the future as well. That's the purpose of being in business. One of the purposes for being in business. It's in all the stakeholders' best interest to have a more valuable business down the road. You as an owner, your employees, it'll have a more secure job, more opportunities, your lenders, if you have them, your customers, your vendors, everybody benefits from that. So Ryan, I don't know if that's the answer you look for, if you have something to add to that, but I think it's just a lack of knowledge and understanding about how that metric is used, because then they don't go to the next step of using it to calculate the value of their business.
Yeah. And yeah, that does answer it. And I think just as we're going along this, if you're watching the recording or everybody that's tuning in right now, is when we get to the end, we're going to show the last tab, which is projecting out the value of your company. You can't do any of that unless you get some of these building blocks correct, right? You don't want to build a house and realize you wish you would have built a foundation in a basement. So what we're going through, some of the foundation parts, so that way you can get to the point where you can see into the future the value of the company.
And so we once you get to EBITDA, and I just made a note, we need to fill in some of these. There are adjustments to EBITDA. EBITDA itself is just a mathematical calculation that you could take any set of financial statements and calculate the EBITDA. The next step is to what we call normalize that EBITDA. And that is to make whatever adjustments to EBITDA that are necessary to get it to a level that would be normal, absent any one-time or unusual events. For example, if you spent $100,000 and had expense of $100,000 to build a new website or something like that, or if you paid a headhunter fee of $50,000 that you don't normally do, so it's a one-time or unusual event, or you brought in a consultant. Gene has probably done this a ton, where bringing a consultant to help with lean manufacturing initiatives so that, you think your operations really have some room for improvement. So you pay a consultant $50,000 to come in, and it's a one-time expense. You add that to EBITDA. Another example is if you're a business owner and you own your building outside of the operating company in a real estate entity, and you may or may not be paying market rent to that landlord just for whatever reason. We have a client, he owns the building in a separate entity, but he wants to pay off the note related to the building quickly. So he's having the operating company pay more than market rent for the building so he can get cash into his operating company to pay down the debt faster. Those are all adjustments to EBITDA, and typically they're adding to EBITDA, so it goes up when you get to normalized EBITDA. But this normalized or adjusted, some people call it EBITDA, that's the key. That's what you get to that said, if somebody else owned my business, this is the EBITDA that they could expect running the business. This happens to be the monthly one. We do it on a year-to-date basis as well. Then you have the balance sheet, your typical, current assets and fixed assets, and then your liabilities, both current, which are your payables, and the current portion of your long-term debt and your line of credit, if you have a line of credit, and then your long-term debt. So it's important to break them out into these categories. It enables you to do ratios and figure your liquidity and how well you're using your working capital and what some of your debt ratios are and things like that. If you lump them all together, it gets tough. And then you have your equity section. So most accounting systems and most people will look at the income statement of the balance sheet. That's pretty standard as long as they're set up right. They're prepared monthly. We have a potential client. We have a client that went through the course. They had a private course for their family. They do their financial statements quarterly. That's just not good enough anymore and not necessary with the systems and the programs that are out there. They should be done monthly, and they should be reconciled so that they're accurate on a monthly basis. Don't want to wait to get to year end and say, we'll clean everything up at year end. That doesn't help you make decisions throughout the year. The third statement, and one that most people don't do, is a statement of changes in cash. We're not going to go through all the details because while I've come close to making Ryan an accountant, that's not the purpose here. But there are three sections. One helps you calculate how it's called cash flow from operating activities. It shows you how well you're using your working capital, which are your current assets / your current liabilities. It doesn't, in an extreme example, if you could have a bunch of sales and they're very profitable, but if you never collect your money, your customers don't pay, then you're not going to generate cash flow from your operating activities. So preparing this will just help you understand how well are we managing our working capital. And that's super important. It became very important in 2020 as some of people's customers, slowed down payments. So that used up working capital as their receivables kept climbing, but yet they wanted to continue to pay their vendors, which continued to use cash. So it's just really important to understand this. The next section is investing activities, which for most companies is just the purchase of equipment. So in this period, this is an actual file from a client. They didn't have any. And then the third section is the cash flow from financing activities. What kind of changes in debt do you have? Everybody can see here a PPP loan. Most people got those, and so that flowed in. How's your line of credit, changing over time, and how are distributions? What kind of distributions are you taking out of the business? This will become really important later on when we talk about out-year projections and trying to figure out how much money can you take out of the business while yet investing in those things going to help you grow the value of it.
These three statements need to be tied out so that in row 188, it needs to equal 0. So that way you can entrust the information, because the decisions that you need to make of what am I spending my money on? Do we have the room in the line of credit? Do we have enough cash to make the decisions that we need to? Do we need to cut payroll? Do we need to increase it? All these things the stories lie in the financials and the stories that the trends tell. So the reason Pat went through the three statements is just to understand why they all need to be tied together. So they're going to be the core foundation to be able to get the information to spot the trends that you can use to make decisions.
So when like I say, we do this on a monthly. Somewhere in this file is the year to date, but the next one that we want to talk about is the TTM.
I was gonna say, before we do that, do you want to jump back to the presentation and kind of toggle back and forth, or do you want to jump right into it?
Yep, I just jumped on. Yeah.
Pat lives in spreadsheets. Rows and columns is how his brain thinks.
Why we're clicking away from an Excel file is a little bit beyond me, but go ahead.
We'll get you back very, very, very soon.
It's not me, it's depriving these great listeners of the joy of looking at a spreadsheet, right?
So and we'll get real fast back to it. So the three statements, as you can kind of see, just for the visual learners out there again, is those three statements all tie together. Then you can look to the past and say, okay, what trends do we have, so we can start working towards the future. And the trailing 12 months is just the income statement. And it is too many times, we were on a call this morning where someone says, how you doing so far? Well, year to date, we're doing really good. Well, compared to what? And so you say, well, how does this November compare to last November? Well, guess what? It's way different this year. So how can you make informed decisions if you can't compare this November to last November, because it's comparing completely different things? So we want to be able to take the seasonality out of that, and the trailing 12 months accomplishes that by, my old business, I think it was like close to 40% of our revenue happened in Q4 because of tax write-offs. So, up until literally the year end, we didn't really know how well we were doing. We were just kind of hoping that the close at the end of the year was going to equal or surpass last year. So Pat, why don't you kind of explain what the TTM does compared to the year to date, which most people are probably familiar with?
Yeah. And Ryan's example of most of their business came in the fourth quarter is a perfect example. If you think about a retailer where they have so much of their sales, in the fourth quarter during the holidays, well, if they're in August, they can't take their year-to-date sales, divide by 8, multiply by 12 to annualize it and have a good representation of what the year might be. We have a client where their first quarter is always their big quarter. And so you couldn't in March or April take the year-to-date information, divide it by 4 if you're looking at it for April, and multiply it by 12 and say that's what we expect the year to be, because that's just not the way the business goes. So trailing 12 months starts from the first day of let's just give an example. If it was November,
jump right into it. We can get back to your spreadsheet, Pat.
It's like Ryan talking without using his hands. So it's just, we're picking on each other today. We're trying to have a little fun here. Trailing 12 month, this is an example in June. So this would have been the period from July 1st of 2019 through June 30th of 2020, a full 12 months. So trailing 12 month, anytime during the year that you are looking at this, you've got a full year's worth of financial activity in there.
You go up to the top where it says revenue, Pat, so they can.
I'm sorry. Thank you. So this for the 12 months ending June 30th, 2020, they had 13,205,000. For the 12 months ending May 31st, it was 13. And you're like, well, okay, that's great, but it's probably not going to change much. But we build these files going back years for clients because it's just really helpful to see the trend. So if you look at June again, and I'm sorry, it's 12 million or 13,000,002. When you get back to August, it was 14,000,003, 14,000,005. So there's a trend there that's not looking so good. You do this for the entire income statement. It does not apply to the balance sheet or the statement of cash flows. All the same income statement accounts and categories. And you get down to net income. So the company in the 12 months into July 31st of 2019 made $39,271. And we just keep rolling it forward, dropping off a month, adding a month. And so you can see here what's going on. EBITDA, you keep doing, you go all the way down till you get to normalized EBITDA. Exactly the same format as the income statement, so that you can say for an entire year, if we take out the seasonality by looking back on trailing 12 months, how are we doing? We actually, take all those numbers and turn them into percents of revenue so that you can also look at trends to say, is my gross profit, how's that holding up on a 12-month basis, not just any 1 month or year to date? How's my gross profit holding up? How are my SG&A expenses, holding up? So it just really helps to, when you build these kinds of models,
we had an interesting example
do things like this to be able to spot trends. Go ahead.
Let's just say we had an interesting example where we had a client that they invested heavily into sales and marketing over the last 6 months, getting prepped for next year once things kind of lighten up. So their percentage of their cost of sales went up, but we should watch that trend and go the other direction to show the return on the investment that they spent. So, I mean, again, if those were one-time things, you would have that as an add back. And that example of why this normalized EBITDA is so important to shift that mindset away from annual income. I had a gentleman show me his income statement. He's like, yeah, but he was explaining again, the story that financials tell. His net income dropped way down. And he's like, yeah, we didn't make as much money. I'm like, but what were you doing? And he explains his activities. And a lot of it was trial and error, R&D, and some one-time expenses. I'm like, the value of your business didn't get impacted. You were trying things, right? So his income went down. So he had less money to spend on distributions for himself or whatever it might be. But your normalized EBITDA and the value of your business is not getting impacted. And so this gentleman is the same guy that said he went from 50 employees back down to 20 because he's like, it's more headache and less cash flow. But he wasn't thinking about the long-term value of his company. So that shift in mindset was crucial for him to understand why he's doing things.
So when you build the trailing 12 months, and any of the financial statements that you have, obviously you can graphically chart them out. But in this case, this is the trailing 12-month revenue at the end of every month, going back to December of 15. So this particular company, you can see the pattern of their revenue. Not a great story, for a trend on a trend basis, but it's hard to kind of just understand that if you're just looking at a bunch of spreadsheets and you're trying to remember what did we do last year at this point, where were we? But when you do this is kind of eye-opening for business owners. And then we do a bunch of other analysis, but this is a chart of the trailing 12 months of normalized EBITDA. And as a business owner, that's not a roller coaster there that you really want to be on, because it's just apparent that this company is not approaching investing in their business and trying to grow with any intention. It's more of, and the owner would admit this, it's kind of taken what comes at them, and you can just see here these huge fluctuations in the EBITDA. We talk about cash flow. I'm sorry, go ahead, Bob.
No, you're going to say it.
We talk about cash flow being sustainable, predictable, and transferable. This is not a picture of that when you come to it. But
and as we show in the last tab, when we get as we wrap up with the presentation, we're going to show the multiple, the 4 or 5 or 6 times the EBITDA. It's how people get to the enterprise value of their business. And the higher the multiple, the more sustainable, predictable, and transferable it is, the more valuable business it is. So even though it's someone here has a $12 million business in revenue, sometimes $1 million in EBITDA, that doesn't mean it's worth $12 million. So the more sustainable and transferable this cash flow is, the more this line goes 45 degrees up, the more it's going to be worth, because the more transferable that cash flow is. So again, we want to be able to reinvest to smooth this out and to continue to grow it in the right direction.
But just developing this kind of information, I'm having computer problems. Anybody want to buy a Dell computer?
Good The Apple and Mac.
No, it's not even. It's
I
not
was
even,
gonna say, do I dare to an
not even,
accountant tell them that they should get a Mac?
not even going to happen. So this is you can do this for SG&A expenses. We have a client who we charted all this in trailing 12 months. You can see their SG&A expenses were just climbing and climbing and climbing as a percent of their revenue, and they're like, well, wonder why we're not making any money. And we can say, right here it is, because the slope was they were spending more as a percent of revenue than their revenue was growing or their margins were growing. So it's just really helpful to put this information together in this format, and for those people who are visionaries or even those who aren't, this just really helps to understand what's going on.
You want to?
I think we're going back to, yes.
So then, as we continue the journey, the next step, as you can, we got the foundation covered. The trailing 12 months is history. If you're just closing your books to file your tax at the end of the year, that's not going to provide you insights. But when you look at the trends that Pat was just showing, that can actually inform some of your decisions. So yes, it's history, but as you can see, there's trends in all these different things in certain areas that you can make informed decisions on. Then the annual budget is something that is going to be from the ground up and done for this year. So I'll give you my example of how we went about this with our business. So before the kind of the turnaround situation we went through, it was, again, bank balance accounting, not really an informed budget. Whatever we did last year divided by 12, file that, pull it back up in 12 months, and hopefully we did better than last year. This if you build from the ground up, all three of those statements that Pat talked about, we can use this as a forecasting tool, but also KPIs for executive compensation plans and profit sharing plans, and making sure we're getting the right customers at the right profit margins. I mean, all the things you need to start from the ground up. So people that hate budgeting, don't do it personally, or haven't done it in their business. We actually had a client a couple of years ago that said, I think he used a curse word and then said budgeting. And now he's the one doing more than he's ever seen, because he's geeking out on all the numbers that he can see, because he's paid off over $1 million in debt and he's been able to reinvest in the business. So it's truly creating wealth. But how to do it to make it less intimidating is so I had 3 different profit centers and divisions, and we sat down and said, what we do last year with the equipment sales, and then there was service, and then IT sales. We went and said, well, what are we going to need to do? What's it going to cost from marketing and infrastructure, or whatever it's going to be, to deliver whatever revenue we've targeted at whatever margins? We built it from the ground up, and then we just reconciled how well we did, and we started somewhere. So I got each of my executives involved, so that way they could own the plan that they put together. And then the comp plans were then layered on top of it. So it doesn't have to be as intimidating. And what we're hopefully showing is that there's a solid reason when we get to the end and you can forecast out the value of the company. This is one of the crucial steps to make that possible.
So
you want to keep going before we jump into the your projections, or you want to just jump right into that? Why don't you just do that?
We can call that one up. Because even though this is labeled out your projections, the budget, you start with the income statement. Most people who do budgeting are very familiar with budgeting out the income statement. And this is one where, again, we were doing this back in the middle of the year, but I don't advise people to recast their budget during the middle of the year. Once you set a budget, that's kind of it. And you hold each other accountable to it. 2020 was an exception for everybody. It's perfectly reasonable to redo 2020. And this is for an example, the client where they were annualizing June, which is not a great idea. But then they said, we're really going to come in at a little bit less than 13. You develop a budget, which is what this this would have been for the client in 2021, on a detailed basis. You look at the components that go into your cost of goods sold to see if your margins are going to hold up. You look at all your personnel costs. Here are the people we have today. What people do we need in order to achieve, like Ryan was saying, achieve the sales that we're projecting, that our sales team is projecting into the next year. It's a very detailed level. You don't worry about office supplies. You take last year's office supplies plus 3%. You know, you don't want to get down to that level where you're counting paper clips. But for the major line items in the income statement, you want to prepare a detailed schedule and really understand what are the costs that are going into that. That's usually where people stop, is they say, well, here's our income statement, and they're projecting this extraordinary growth, you know, over the next year. The question becomes, can they afford it? When you prepare your budget, and in this case, you can ignore these for now, you want to project out your balance sheet. And you're like, well, how do I know what my accounts receivable is going to be at the end of 2021? There are ways to do that. There are metrics: day sales outstanding. You look at inventory, days inventory outstanding. You look at your payables. You know, you track your line of your debt. What principal payments do I have to make? It is not that difficult to project out your balance sheet. Oh, sorry about that. But most people don't do it. And why is that important? Is because, especially in times of growth, you want to understand, am I going to be able to support, from a working capital point of view, the growth that I'm projecting? And if you project out your balance sheet, what you think it's going to be from payables and inventory and receivables, then you can come down and do the third statement, which is just it just derives from the other two. Here's my statement of cash flows, and it will show you if those assumptions that you used in the income statement and the balance sheet are right. What is it that we're going to generate cash flows from operations? What kind of plant, property, and equipment are we going to have to buy? And what kind of distributions and changes in debt are we going to have to go through? It is really helpful to do that. In all this, when you project out the balance sheet and the statement of cash flow, the plug number to make the balance sheet balance between assets and liabilities and equity is either cash or line of credit, depending on if you have cash or you're having to draw on your line of credit. This is super insightful for people, especially when they develop strategies for growth, deploy them. I can't tell you how many times I've seen in my career where people have these great, really great growth strategies they cannot afford.
I was just going to say, so let's take coming from a mainly sales organization of copier sales and more visionary, and say, okay, we're sitting in our annual strategy meeting, which people are probably doing right now, and saying, I want to hit 20 million in revenue. We're going to sell this many more pieces of equipment. We're going to launch a new location in a different marketplace, right? And look at how much money we can make doing that. And when Pat says the plug, where is that money going to come from? Do you have enough cash? Are you tapping your line of credit? Because all that costs money, right? I mean, there's very few businesses. Maybe Pat, you can kind of walk through, because this ties to the future value of companies too. But like, if we didn't collect any of our equipment, so we had to buy all the equipment, we had to hire the people before we before we collected our money from the clients. So who's going to cover that 6-month float? Versus, you have the opposite end of the spectrum where you have an e-commerce client or a customer or a company, who is collecting deposits first. Completely different process. I mean, you can truly grow yourself into bankruptcy.
Yep. And, you see here a line called distributions. How does, with all the investments, if you have to make $150,000 investments in plant, property, and equipment, you want to take out that amount of money. But your operations only generating $162,000. So cash flow from all activities, you're eating up, $500,000. Well, that's not sustainable over time.
Yeah, that's real money.
It's real money. So once you do your budget, and we don't have a separate tab or workbook for that, but you do it for your budget year. Then what you do is go through a similar exercise for what we call the out years. So the next 3-4 years, you go through a similar exercise, but not in the detailed level that you did for the budget year. The budget year is a detailed look. The out years are sales should grow 7%, then 4%, then 8%, whatever you might be. Our margin percentage is going to stay consistent, or it's going to decline or increase. Our SG&A is going to track in a certain way, all based on strategies that you develop that say we need to make these choices, these strategies, which are going to give us the highest likelihood of achieving the goals and objectives that we set out. So what you have to do is take those strategies for the next year, 2 years, 3 years, and translate that into the financials to see, if we can afford that kind of growth. If it takes debt, do we have that kind of tolerance for whatever level of debt it might be, because you project that out. And the third part, which we're going to get to, is what does that do to the value of my company? I could go out and borrow a ton of money to invest in things. If it doesn't yield higher normalized EBITDA, I'm not really benefiting the value of my company, because I'm loading up a whole bunch of debt. I'm not saying debt's bad. Debt in the right amount can be a super valuable thing to have, but you've got to understand the whole picture of how does that debt fit into the value creation desires that you have.
And you have to pay off your debt when you sell your business. So we actually had a client that
let's not get ahead of ourselves real quick.
All right.
I'm gonna make him wait for a second.
I want to talk about how much does this mean to me?
So going in the out years, projecting the income statement, the balance sheet, and the statement of cash flow is best practice. If it seems like it's overwhelming, it's not. It's I mean, people have been doing double entry accounting since the 1400s when the monks invented it. It takes some work, especially the first couple of years. But once you get into a habit, you develop a model, then it just flows like clockwork, and you can get to the point where you're continually looking at what this is doing. And in this case, this company took a hit and they're back building, and you can see their cash generated from operating activities is climbing steadily. So that
while taking the distribution. So like, again,
and paying off debt.
Right. And so going back to one of your comments, Pat, is like, yes, this does seem like a lot. If you're not a finance person, this can be sometimes overwhelming. To steal a quote from Pat, is it's not complicated, it's hard work. And I think what truly makes it more difficult than ever is a lot of times either a finance department or the staff that we used to have that were our employees, they didn't know what we wanted. They didn't know how much we wanted in distributions. They didn't know what kind of strategy they want. So they were they were getting whiplash all over of like, we need money for this personally, but then we want to reinvest over here. And so they're trying to do all these things, just trying to keep the thing going, instead of saying, okay, what do we want to forecast out for cash, for distributions, for taxes, and let's pre-plan this and then make decisions around that. So I think it's that translation of what does this mean to me and how do we bring that into the business, knowing that there's personal and business overlap, and those are decisions that impact both. But if you think about it, then you can translate that. What does that mean for the cost and the investments of the company?
Any questions that anybody wants to pose at this point? I mean, we've been talking for an hour now. Anything in particular that we kind of skimmed over that anybody wants to ask a question about? Okay, hearing none.
Well, the one thing that I wanted to point out, Pat, that I don't know if you guys had said already, is that the benefit of doing this it definitely has the fold if you want to sell your business, right? We know that. That whoever would be wanting to value your business or acquire your business is going to do all this on their own way. And if you don't do it now and get used to it, it gets to be super challenging when you're at the point trying to put it all together. And I think that's and then you get the benefit of using it, until you're ready to do something with it. And then you can beat them at their own game because you know how they're going to think.
You're exactly right on that. I mean, you get the benefit of using it and helping and using this information to help make good choices about strategies. it's strategic planning can mean different things to different people, but going through a process to say, what strategies do I need to engage in order to achieve what I want to achieve in the growth of the value of my company is super important. And these financials are critical to it. Any potential buyer is going to go through all of this themselves. And if you arm yourself with this information, if you have it, and you got to the point, if you got to the point where you said, I want to sell my business, and somebody said, well, can you give me the last 3 years of financials? And most people, their shoulders drop and they sigh and they think about digging into their drawer, to find and copy and scan 3 years of financials. If you say, hey, let me send you we call it the ongoing file because we can't figure out a better name for it yet. But if we say, hey, let me send you this file, it's got the last 6 years on it, and it's got trailing 12 months, and it's got the 3 statements, and it's got a bunch of metrics. You have put yourself in a position from a negotiating point of view that a potential buyer is going to say, well, who are you? I mean, what are you guys all about? You've really positioned yourself because you have the information. And one point, and you can supply it to them literally while you're on the phone. You can send them the file. One thing I failed to mention, part of all of this is the understanding can't just reside with your CFO. The leadership team has to understand these financials because financials are the language of business. And so, sorry, Ryan, but down to the marketing and sales person, they need to understand this. And that's what we spend a lot of time with clients is educating their leadership team. We have one client and the owner's got to the point where he makes all the other members of the leadership team calculate current ratio and report on it every month, before they get the file and do that, just to make sure they're paying attention. But that education of the leadership team is super important. So you get the first part of what you said, Gina, is the benefit of having this information all along to make decisions. Then secondly, when you do get to the point where you want to transition your business, you're in a much better position of strength in the negotiation that you would be otherwise.
Yeah, and a couple of comments on that is that, this client actually sent this file to an out of the blue offer within the last 6 months and said, unless you're willing to pay me X, because in 5 years I will get X, you give that to me now. Otherwise, I'm not going to do this. 2-second conversation versus too many people I've interviewed on the podcast where 2 years of negotiating with a private equity firm, $500,000 advisor fees, and they didn't sell. Like, oh my gosh, the mental and financial drain on that. Also, the second comment on this topic is, if you have this data and this information, it actually lessens burnout. Too many people go, I'm burnt out, I want out. And first, out of what? Your job, the financial investment in the business, or what? And they can't even articulate it because they're just so exhausted with keeping the whole ship together. And it's like, well, if you actually had this information, you could more easily make decisions, delegate to your executive team. Your executive team then knows the financial information. You've worked yourself out of all the stress, and now you might not actually want to sell, and you're like more concerned about the distribution. So I think, all of this that we're talking about leads to more valuable business, that leads to less stress, more predictability in your distributions and the cash flow, and more options or ideas when a decision has to come down the road. So we're working our way up to the pinnacle here, which is, what does this all mean? We talked about all your projections. This is what completes the era of showing, okay, where are we going? Why are we going that? And again, there's no right or wrong. If you think about doing the strategic planning sessions or your end of the year, your revenue, your profits, all those things are going to be tied into how much do you want in distributions, and then what's left over to reinvest, and then what's a realistic and obtainable goal. We're going right back to your spreadsheet, Pat.
What?
Yep, the value gap analysis and the valuations. So we got probably about 10 minutes ish, and then we'll wrap up for some Q&A.
So what happens with all this is when you get this information, and the big question that people have is, what is my business worth? And you may talk to friends, relatives, colleagues in the community. They will say, I sold my business for $10 million. Not sure what that means, if they don't tell you, but let's walk through how that comes about. You start with normalized EBITDA, and if you use this for that all the way to the out year projections, you can predict what that is. Everybody's probably heard about multiples. Somebody paid me 4x for my business, 6x, 5x. That X is 5 times normalized EBITDA. So that's just what people say. And we've got a whole section about how those come about. But when you multiply your normalized EBITDA times a multiple, you get an enterprise value. That's the top line purchase price. If you think about your house, you may put your house on the market for $300,000. That's the equivalent of enterprise value. So somebody may say in a social setting or business setting or whatever, I sold my business for $4 million. They're probably talking about enterprise value. Chances are that's not what went into their bank account.
Like very small.
Just saying, people might be exaggerating a little bit.
And
Equity value. Go ahead.
I was just saying, right before you get to equity value, just a comment on those multiples we talked about in the last presentation. If you want to go in and take a look at that, principle 4 about increasing value is about how to grow from a 4 to a 6 by de-risking your cash flow, by making it more sustainable, predictable, and transferable. That's how that number changes based on the risk of your cash flow.
So when you're valuing a company, whether you're selling it or you just want to know what the value would be, you go from enterprise value to equity value. The difference is what's called net debt. When companies are valued or you enter into a transaction, the seller typically gets to keep the cash that's in the business, but the seller has to pay off the debt. The difference between those is called net debt. And so you'll see here in the early years, the net debt for this company was $416,000. So for each of these enterprise values, you subtract the 416 to get these equity values. So you can see here $1,225,000 turns into $809,000 in equity value. You can see here where the net debt went positive. That means that the cash was greater than the debt. So if you get to keep your cash, but you got to pay off the debt, this scenario that they laid out is going to flip that around. So there's $1.5 million swing there, just by the virtue of now they've got more cash than they do debt. So we put a multiple range because, as Ryan says, as you grow bigger, typically your multiple will go up because your cash flow is more sustainable, predictable, and transferable. So a company on the low end that today, from an enterprise value that might be worth $980,000, could be worth at a 6 multiple, and this normalized EBITDA almost $9 million.
This is real stuff. This is why the industry of private equity exists, because they understand this. And going back,
they want to buy here and sell here.
Who doesn't, right? And like, and this is where some of these themes tie together is, if this business, like going back to that chart, so normalized EBITDA looks like an EKG. If it looks more straight and 45-degree upwards, it's worth more money. So the reason that someone wouldn't fix this is because they're solving for annual income and they want to take those distributions, sacrificing the investments that could de-risk it. And by investments, I'm talking about new VP of sales, new ERP system, all the things that you have to buy and invest in to straighten out and make your cash flow more sustainable, predictable, and transferable. So the way to do this is to reinvest in order to grow that multiple, to make it more transferable. And to Pat's point earlier, and why equity value matters is you could finance your way all the way there. So we had a client that said, okay, I want to get to 80 million instead of 50 million. Of course, who doesn't? And that's in revenue. But after he went through his strategies, how he would have to do that, it would be taking on another $15 million in debt. So he would actually net less money in 5 years than if he grew it to 65 million. I mean, so then he's like, wait a second. I mean, now understanding all this could really impact the strategies that you want to employ or deploy.
Yep. So we go from enterprise value, taking into account net debt, to get to equity value. And to real quick, if you have your house on the market for $300,000 and you owe $200,000, your equity in it's $100,000. Very similar concept. That's not the end of the story, however, though. This is a table that shows some of the same information. The revenue, the normalized EBITDA was the same from before. The assumed multiple. So here's where we go from a 4 to a 5. We didn't go to a 6. We went to a 5. They grew the company. They reduced risk. They drove up the multiple because their cash flow is more sustainable, predictable, and transferable. So their enterprise in this example went from 980 to 7.4 million. And here again is the net debt from the other schedule. So their equity value went from a little under 600,000 to 8.5 million. If you were to sell your business, you're going to have some transaction costs that we just peg at 3%. And then you have to, and I don't know what the tax structure is in Arizona. I know what it is in Ohio and Minnesota, but there's federal tax. So you want to come down to your net proceeds. What would go into your bank account if you sold your business? I'm not saying that this is all about exits, but just to understand, if I sold today and I kept the cash, paid down my debt, paid some closing costs or for the sale, paid capital gains tax rates, we're assuming a stock sale here, what would go in my bank account? Because that's the critical number. If you could grow like Ryan just gave the example, you could grow your business by $20 million in sales, but if you had to take on a bunch of debt to do it, so your equity value actually went down and then you had to pay tax on the gain, you could be worse off. This is what's important to know. In our example, if they sold at what they projected at the end of 2020, they'd pocket about $665,000. If they implemented the strategies that they're trying to, and they yielded the results that they're anticipating, that could go to $5 million. That's a big difference. That's the difference of being intentional as opposed to this.
And the difference between solving for annual income and long-term value creation, because this individual is going to be reinvesting so they can get that $5 million. Because if they don't do it, some private equity firm or someone down the road will. And, if you think about going back to the big decisions that as business owners we all have is, I want to grow at 40% year over year. I literally interviewed a guy on my podcast. He said he grew at 40% year over year, just explosive growth, grew himself into bankruptcy, had to sell the business. He said, if I would have grown at 25%, I would have been able to have an insane amount of cash flow because he couldn't service all of the investments that they were trying to make. So you're weighing these decisions of what's my growth, what kind of growth, how much profit is going to be generated from that, how much do I want to have in distributions, can we forecast out our taxes, all these things that are pretty basic that we all know we need to do, but it's done at the end of the year. And then we just wake up and run for 12 months and then wake up again in 12 months. And the goal is you look out. The guy I just interviewed on my show, different gentleman, I said, why'd you sell? And his one quote was, I was stupid, because he didn't know he could have hired some people to create a more valuable business and work himself out of his job. So it's just about knowing this will inform your decisions. And there is no right or wrong answer. Like if you wanted to use all the distributions every year, that's fine, but just know how that's going to impact the value of the business, that you're not going to just randomly have a $12 million business some year if you pulled all the cash out of it and didn't reinvest. There's give and takes on all these, and you just need to understand what they are so you can make the decision.
Any particular questions on this? We want to leave a few minutes for questions, and just Ryan to let you know, I do have another call at 2:30 my time, so I got to jump off at 2:28.
I think that I can just pull up the last slide, but that's pretty much the last part of the presentation. I'll just make a
So one of the things that I just wanted that you touched on, Ryan, is that right now there's a lot of money in private equity right now, because there just is. There's just a lot of money. There's a lot of people that are looking for alternative ways to invest their money. And so private equity is another way for people to do.
Oh,
sorry, I just got a telemarketer come through. Sorry about that. One of the things that I've seen in some of my clients is they're getting a lot of calls right now because they know that over the last 6 to 8 months, running a business has not been for the faint of heart, because of everything going on. And so they know that a lot of business owners are really ripe for doing this. And so I don't know if you've seen the same thing. And so having this information is a huge opportunity for people.
And Gina, on that point real quick, even though we've had 2020 be what it is, it's still, I was talking to an investment banker yesterday with a client. It's still kind of a seller's market. I mean, there's so much money in private equity that's looking for a home that you would think in this market that the power shift might have gone over to the buyers. It is, the sellers are still in the driver's seat. Understanding this information, understanding what your business is worth is so important. I tell this story, and if I told it last time and I repeat it, I apologize. I worked for a company. We wanted to make an acquisition, engaged in negotiations with a competitor. We paid the gentleman exactly what he asked for a purchase price. I mean, literally down to the nickel. And we closed the deal, and we ended up paying the man about a third of what his company was worth. Now, I work for the buyer, so it's not my job to tell him, hey, you're underpricing your sale here. We didn't take advantage of him, didn't do anything underhanded, nothing whatsoever. He had no idea about valuations. His advisors weren't really sophisticated, and he ended up selling his business for about a third. It is so important to get your hands around this, understand valuations, get good numbers in your financials, understand what they are, because private equity firms, they'll actually pay a little bit more than you might expect in this market. They've got so much dry powder and committed capital that they have to deploy in order to get a return for their investors, that they're willing to pay a little bit more in some cases, just to get that capital deployed. So understanding this puts you in the driver. It levels the playing field between, you don't have to have a degree in finance or have super high paid advisors. Just getting the basics accomplished is going to really put you in the driver's seat.
And Pat and I didn't cover a bunch of this in this presentation. We do in our course and that cohort that's coming up next year. But just because you get that enterprise value, might say $7 million, that doesn't mean that's what you get in cash. So, the talk about the decisions, Gina, that you just mentioned. If you get an out of the blue offer, and if we were to look at that example client and someone says, I'll give you $8 million, I want to, if I'm the owner, if I have super solid confidence that we're going to hit those numbers and I've got my investments, I'm going to hire a CEO and all these things, and it's under my direction, the chance of me hitting that $8 million valuation are pretty high. Why sell it? Well, maybe because someone offers me 10. So then you go, okay, well, for $10 million, now I'm considering this. But what if it's $2 million up front and you're going to have to be employed for 4 more years and you're going to get a seller's note for the rest? And you go, well, wait a second. I'm going to still be here with all the same stress to hit the dollar amount that I was already going to do anyways. So you start to be able to weigh these decisions, to your point, Gina, of like, if you do this, it's just about, there's nothing wrong with selling or keeping. It's just that you made the decision on purpose, right? Like you said, I'm willing to keep it because it's easy for me. It's reasonably within the realm of possibilities that I'm going to hit those numbers with the right amount of energy and stress versus not, so you're just weighing that and being able to quantify with the numbers that you have versus someone says $8 million and people will jump all over it to only have 2 years later to realize that they only would have pulled down 800 grand.
Questions anybody has? Something we didn't cover very well, or you just want a little bit more discussion about?
Well, this is recorded. We got a bunch of material and stuff coming out there's the podcast on Arkona. Michael, you want to give, I don't know if you get what the process is of notifying everybody about the cohort coming up, which is our, the recorded, before COVID, we had a 2-day live boot camp on the 5 principles with 2 case studies.
The last one we did was in Tucson, by the way.
Yeah, that's March 3rd, 4th, I think it was. And now it's digitally recorded and online in some nice bite-sized chunk videos with some exercises that we facilitate with virtual cohorts that we're partnering up with. So pretty excited about that.
Well, that's excellent. And Brian, Pat, thank you so much for doing this. This two-part series, like I said at the beginning, has been just filled with fantastic information. You kind of joke that it's not so exciting to see spreadsheets on a screen, but it's important. I mean, that tells the story. So you can't really tell the story without doing that. And so it's just been extremely valuable. And it's not just, like you said, the CEOs or the top level executives that need to understand this. It's really a lot, the leadership team, a lot of people within the organization that needs to understand this, because, you know, as one of the sayings goes, money makes the world go round. And the better we understand as a business and a company or a nonprofit or whomever, truly understand what those financials look like, and how that really tells the story for the future of your company, the better off and stronger you will be as a company. So thank you so much again. We are going to, like you talked about, distribute this. We are going to get the word out about the cohort early next year, and you know, get people really interested and excited about this great product. So thanks to Ryan and Pat, thanks to Arkona. Really appreciate you being here, and have a wonderful day.